Today, we're examining the actions that the Federal Reserve might take on May 3rd. The outcome of their decisions could either lead to a surge or a downfall in the stock and cryptocurrency markets. Additionally, their actions will have an impact on the bond and housing markets as well as the overall economy. It's crucial for us to anticipate their decisions as the Federal Reserve holds the power to control the situation. Here's what we need to find out regarding the events on May 3rd. Firstly, we're eager to know whether the interest rates will be increased or remain unchanged. Secondly, we're curious to learn about the timeline for the initiation of interest rate cuts and the resumption of printing money. While keeping these three queries in mind, let's take a look at the details shared during the Federal Reserve's previous meeting, which concluded on March 22nd. On Wednesday, the Federal Reserve released its minutes, which could provide us with insights into their actions on May 3rd. If you're unaware, the Fed minutes are a form of communication that's published after a regular FOMC meeting. They provide additional details about the decision-making process and rationale behind specific policy actions, including the viewpoints of individual Fed members and more in-depth perspectives on the U.S. economic situation and the overall Fed balance sheet. Savvy investors can utilize the Fed minutes to gain useful information about the Fed's general policy and how it might affect their portfolios over the long run. According to the minutes, some members of the Fed proposed a 0.5% increase in interest rates during the previous meeting. However, due to the collapsing regional banks, the Fed decided to raise the interest rates by only 0.25%. The question arises, would the Fed have gone through with the 0.5% hike if there were no banking crisis? It seems that the answer is yes, as there's a high possibility that they would have pursued the 0.5% increase, but they opted for a cautious approach due to the banking crisis, settling for a 0.25% increase instead. The minutes state participants would have considered a 50 basis point increase in the absence of the recent developments in the banking sector. The participants reached a consensus that recent developments in the banking sector would be taken into account when making the committee's monetary policy decisions. This confirms what I've mentioned multiple times before, that the Federal Reserve is carefully observing the banking situation and it's influencing their decision-making process. The Fed minutes, which were published on Wednesday, explicitly state this. Additionally, I previously mentioned that credit flow would also have an impact on their decisions, and this was confirmed in the minutes. The Fed acknowledged the need to monitor data to predict a potential credit crunch and emphasized the importance of maintaining flexibility in their decision-making process. Therefore, the four primary factors that the Federal Reserve is monitoring are the March CPI report, the jobs report, the soundness of the banks, and credit flow. I hope this explanation is clear. Let's shift our focus to the March CPI report. The headline CPI decreased from 6% in February to 5% in March, which may seem like a positive development. However, when you delve deeper into the details, it's not as favorable as it appears. In fact, the stock market declined after this news was released. Some individuals believe that the significant decline in headline inflation implies that the Federal Reserve will not raise interest rates on May 3rd and instead choose to pause. On the other hand, the opposing viewpoint is that core inflation presents a different picture. In particular, core inflation rose by 0.4% month over month, and year over year core inflation increased to 5.6%, which is a faster pace than February's 5.5%. Therefore, the persistent rise in core inflation will continue to exert pressure on the Federal Reserve to raise interest rates once again. These are the two differing opinions, with one based on headline inflation and the other on core inflation. The question then arises as to which of these two measures the Fed prefers to utilize as a better indicator of inflation. The answer is that the Fed favors core inflation. However, core inflation remains high and the trend is still upward. This is a cause for concern, particularly as oil prices are on the rise again. This means that headline CPI could quickly jump back up in any given month. Let's move on to the topic of the jobs report. The report for March demonstrated relatively strong performance with 236,000 jobs added. The labor market remains tight, which was an indication of how services inflation would manifest itself in the CPI reports. As anticipated, it appeared high, with a year-over-year increase of 7.1%. This figure was only slightly lower than February's 7.3%. It's noteworthy that this value is significantly higher than the core inflation of 5.6%. the headline inflation of 5% and the 2% target. Additionally, the unemployment rate decreased from 3.6% in February to 3.5% in March. The Federal Reserve predicts that the unemployment rate will rise to 4.5% by December. Regarding this aspect, it appears to be a signal for the Federal Reserve to apply more pressure on the labor markets. However, it's necessary to examine the state of the banking industry. According to the recently released Fed minutes, the banking disruption is expected to be confined to a limited number of institutions with deficient risk management practices. The Fed also stated that the banking system is still healthy and robust. Therefore, it does not suggest an interest rate pause. It appears that the Federal Reserve thinks they can increase interest rates by another 25 basis points, and the banking industry can cope with it. In terms of credit flow, the data shows that it's decelerating, but it's not come to a halt, at least not as of now. Furthermore, the Federal Reserve perceives the restricted credit flow as a measure to combat inflation. They have an optimistic outlook on the matter, believing that after another rate hike, they can refrain from raising interest rates since tighter credit flow can stifle the economy and decrease inflation. In other words, the Federal Reserve thinks they can control inflation by restricting the American consumer's purchasing power. Essentially, their thinking is that tighter credit will suffice and eliminate the need for any further rate increases. However, recent data indicates that banks are lending less due to expected turmoil, causing them to be more defensive. Small businesses are also experiencing more difficulty obtaining loans compared to last year, as indicated by the New York Federal Reserve survey. Let's examine the other surveys which are expected to reveal similar trends. As the Fed pointed out, bank lending shrank by the most on record in the last 2 weeks of March. However, it's unclear how much further banks will restrict credit availability. After analyzing these 4 factors, I think the market expectations of a 66% chance of a rate hike and a 34% chance of a pause are reasonable. So to summarize, the answer to the initial question of the probability of a rate hike or a pause is 66% and 34% respectively. In summary, there are more reasons supporting the idea of a 25 basis point increase, which is why the probability of a rate hike is higher at 66%. However, if the Fed does decide to raise rates, both the stock and cryptocurrency markets may not react positively, given that a significant portion of people still expect a pause. As for the second question, when the Fed might start cutting rates, Jerome Powell and the Fed have made it clear that it won't happen in 2023. On May 3rd, Jerome Powell is expected to reiterate his stance that a Fed pivot is not going to happen in 2023. However, the market seems to doubt his statement, as they're predicting a pause at the June meeting, a 50% chance of a Fed pivot at the July meeting, and an 80% chance of a Fed pivot by the September meeting. It's important to note that while this may be common knowledge for most, it's worth mentioning for those who may not be up to date on the current market expectations. A pivot by the Fed doesn't necessarily mean an immediate shift to a bull market. History indicates that there could be more market decline following the pivot due to lag effects. The final question is, when will the Federal Reserve begin to engage in expansive monetary policies and fuel more financial bubble? Currently, the Federal Reserve is implementing quantitative tightening, also known as QT, which is essentially the opposite of money printing. However, due to the ongoing banking crisis, the situation is not as straightforward. In reality, the Federal Reserve is engaging in a temporary practice known as stealth QE or backdoor QE. It's not exactly printing money, but it's not entirely different either. In other words, it's a unique approach that falls somewhere in between the two. If we ignore the unclear situation of the current Fed policy, the question remains, when will the Fed resume the money printing QE process? On May 3rd, they'll likely reiterate that there will be no QE in 2023 and will stick to their QT policy. The Fed will probably start cutting interest rates before implementing QE, as there's a natural progression to these policies. Please subscribe. Thanks for watching. Until next time.